The biggest lie about getting rich. Most people believe one dangerous lie. They believe that getting rich is the finish line. They think once money comes in, life becomes safe, stress disappears, and success is guaranteed forever. But this belief has destroyed more wealth than bad investments ever did. The truth is uncomfortable. Getting rich is easy compared to staying rich. Every year, millions of people make money. Some through business, some through jobs, some through investments, some through luck. But very few manage to keep that money for decades. Why? Because making money and managing money are two completely different skills. The illusion of "I've made it." Imagine someone who suddenly makes a lot of money. Maybe a business starts doing well. A stock goes up fast. A promotion doubles income. A lucky investment pays off. At that moment, confidence shoots up. They start thinking, "I'm smart. I understand money now. I can't lose any more." This is where the danger begins. Money creates false confidence, and false confidence leads to bad decisions. Many people don't lose money because they are foolish. They lose money because they overestimate themselves. They stop being careful. They stop thinking long-term. They start believing the money will keep coming automatically. History shows this again and again. Real-life examples that nobody talks about. Look around. Athletes who earned millions and went broke. Celebrities who lost everything. Lottery winners who ended up poorer than before. Business owners who made fortunes and lost them all. These people didn't lack money. They lacked a system to keep it. Money without strategy is temporary. Why getting rich feels easier than staying rich? Getting rich often happens because of one good decision, one lucky opportunity, one booming market, one successful business. But staying rich requires hundreds of correct decisions, emotional control, patience over decades, avoiding major mistakes. One mistake can destroy years of success. That's why Charlie Munger says, "It's not supposed to be easy. Anyone who finds it easy is stupid." Wealth is fragile if not protected. The world is designed to take your money back. Here is something nobody tells you. Once you have money, the world starts attacking it. Banks want fees. Markets want you to trade. Media wants your attention. Social pressure wants you to spend. Ego wants you to show success. Everywhere you turn, someone is trying to separate you from your money. Advertisements say, "You deserve this. Buy now. Upgrade your lifestyle. Don't miss out." Markets say, "Quick profits. Hot opportunities. Once in a lifetime chance." Most people fall for it, not because they are weak, but because nobody taught them how to protect wealth. The emotional side of wealth loss. Losing money hurts more than making money feels good. But here's the problem. Most people don't lose money slowly. They lose it emotionally. Fear, greed, impatience, ego. These emotions push people to sell at the worst time, buy at the peak, chase trends, overtrade, take unnecessary risks. The market doesn't punish ignorance. It punishes emotional behavior. Why intelligence is not enough. One of the biggest myths is, smart people make good investors. Reality. Some of the smartest people lose the most money. Why? Because intelligence can increase. Overconfidence, complexity, ego. Charlie Munger noticed this early. He realized, IQ doesn't protect you. Degrees don't protect you. Talent doesn't protect you. Only behavior does. That's why his entire philosophy is based on avoiding mistakes, not showing brilliance. The difference between flashy wealth and lasting wealth. There are two types of wealth. 1. Flashy wealth. Quick gains. High risk. excitement, stress, short lifespan. 2. Lasting wealth, slow growth, discipline, boring process, calm mindset, decades of security. Most people choose flashy wealth because it looks impressive, but flashy wealth disappears quietly. Lasting wealth grows quietly. The silent enemy. Time. Time is either your biggest enemy or your biggest ally. If your strategy is weak, time will expose it. Bad habits compound. Mistakes multiply. Small errors become disasters. But if your strategy is strong, time becomes magical. Small wins grow. Discipline compounds. Patience creates exponential results. This is why strategy matters more than income. The real question you should be asking. Most people ask, how can I make more money? Smart people ask, how can I make money and keep it? But the wisest people ask, how can I build wealth that survives my emotions, mistakes, and time? That question changes everything. Why this video exists. This video is not about getting rich quick, trading tricks, secret stock tips. This video is about protecting wealth, building money that lasts, avoiding the mistakes that destroy fortunes. The strategy we will discuss is not exciting. It will not impress people at parties. But it works. It has worked for decades. It works across markets. It works across generations. And most importantly, it keeps you rich forever. The one investment strategy explained. Now we come to the heart of this video. Everything so far was preparation. Because without the right mindset, even the best strategy will fail. So let's clearly answer the question. What is the one investment strategy that keeps you rich forever? The answer is simple. Almost disappointingly simple. But simple does not mean weak. The strategy in one sentence. Here it is. Buy a small number of great businesses, hold them for a very long time, and let compounding do the heavy lifting. That's it. No secrets. No shortcuts. No excitement. Most people hear this and think, that's too basic. And that is exactly why most people fail. Why this strategy sounds boring, but works. Humans love excitement. We are attracted to fast results, big promises, constant action. This strategy offers none of that. It offers waiting, doing nothing, trusting time. And that makes people uncomfortable. Charlie Munger once said, the big money is not in the buying or selling. It's in the waiting. Most people cannot wait. They want proof immediately. But wealth doesn't work like social media. It grows quietly. Buy a business, not a stock. The first rule of this strategy is how you think. You are not buying a stock price. You are buying ownership in a business. That means asking different questions. Does this business make real money? Will people still use its products in 10 or 20 years? Does it have loyal customers? Is it hard for competitors to replace? If the answer is yes, you may have found a great business. If you don't understand the business, you don't invest. This rule alone protects you from most losses. Why great businesses matter. Not all businesses are equal. Some companies constantly struggle, depend on trends, have weak profits. Others have strong brands, stable earnings, pricing power, long-term demand. Charlie Munger focused only on the second group. Why? Because great businesses survive recessions, recover from crashes, grow steadily over time. Average businesses need perfect conditions to survive. Great businesses don't. The power of holding long-term. This is where most people break the strategy. They buy something good. Then they sell too early. Why? Price goes up, they take profit. Price goes down, they panic. Market becomes boring, they lose interest. Every time you sell, you reset the compounding clock. Charlie understood something very few people do. Time in the market matters more than timing the market. Holding allows profits to reinvest, earnings to grow, value to multiply. Selling interrupts everything. Why frequent action is dangerous. Action feels productive. Doing nothing feels lazy. But in investing, it's the opposite. Frequent buying and selling causes emotional mistakes, higher taxes, missed long-term gains. Charlie Munger avoided action unless it was necessary. He waited for the right business, the right price, the right opportunity, and then he waited again. Compounding. The silent wealth builder. Compounding is simple but powerful. It means your money earns returns. Those returns earn returns. Over long periods, growth accelerates. At first, nothing seems to happen. Then slowly, numbers increase. Then suddenly, growth becomes explosive. But compounding only works if you stay invested. You don't interrupt it. You avoid big losses. This strategy protects compounding at all costs. Why most people quit too early. Most people underestimate time. They expect results in months, a few years. Charlie thought in decades. He once said, "If you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This mindset changes everything. It removes pressure, anxiety, constant checking, and replaces it with confidence. Fewer decisions, better results. Another key part of this strategy is concentration. Charlie did not believe in owning hundreds of stocks. He believed a few great ideas beat many average ones. Why? Because focus improves understanding. Fewer decisions reduce mistakes. Quality matters more than quantity. Owning too many things creates confusion. Confusion leads to emotional decisions. Risk is not what most people think. Most people think risk means price going up and down. Charlie disagreed. He believed real risk is permanent loss of capital, owning weak businesses, emotional selling. Price volatility is temporary. Bad decisions are permanent. This strategy minimizes permanent risk. Why this strategy keeps you rich forever. Let's connect everything. This strategy avoids unnecessary risks, reduces emotional decisions, maximizes compounding, uses time as an ally. It doesn't try to be clever. It tries to be durable. And durability is what keeps wealth alive. Quality over quantity. One of the biggest mistakes investors make is believing that more equals safer. More stocks. More ideas. More activity. Charlie Munger believed the opposite. He believed that quality beats quantity. Always. And this belief played a massive role in keeping him rich for life. The illusion of safety in numbers. Many people think owning many investments reduces risk. They say, "I'm diversified. I'm playing it safe. One bad investment won't hurt me." But often, this creates a false sense of security. Owning many average businesses does not protect you. It dilutes your best ideas. Charlie Munger warned against diversification. Diversification that actually lowers returns. Why people love quantity. Quantity feels comfortable. It feels busy, active, professional. People think, if I own many things, I must be smart. But intelligence is not measured by how many things you own. It's measured by how well you understand what you own. Charlie Munger's view on concentration. Charlie Munger believed, a few great ideas are enough. You don't need many winners. You need a few very good businesses. He once said, "The idea of owning many mediocre businesses instead of a few great ones makes no sense to me." He preferred deep understanding, high conviction, long-term ownership, not scattered attention. Why great businesses matter more. A great business has strong demand, loyal customers, consistent profits, ability to raise prices, competitive advantages. These businesses survive recessions, recover from crashes, grow steadily. Average businesses struggle when conditions change. Quality businesses adapt. The power of competitive advantage. Charlie Munger often talked about moats. A moat is what protects a business from competitors. Examples include strong brand, network effects, high switching costs, unique products. Moats allow businesses to earn high returns, defend profits, grow over decades. Without a moat, compounding becomes fragile. Fewer businesses, deeper understanding. Owning fewer companies allows better research, stronger conviction, emotional stability. When you deeply understand a business, price fluctuations bother you less. You know why it will survive, why it will grow, why short-term noise doesn't matter. Understanding creates patience. Quantity increases emotional mistakes. The more you own, the more decisions you have to make. More decisions equals more chances to panic. People with too many investments forget why they bought, react to news, sell randomly. Confusion leads to fear. Fear leads to bad decisions. Quality simplifies life. Charlie Munger valued simplicity. Quality investing simplifies decision-making, emotional pressure, monitoring. You don't need to watch everything. You don't need constant updates. You trust the businesses. Why average businesses are dangerous. Average businesses depend on perfect conditions, have weak pricing power, face intense competition. They look fine in good times. They collapse in bad times. Quality businesses survive storms. That survival is what protects wealth. Long-term compounding loves quality. Compounding works best when earnings are consistent. Businesses reinvest wisely. Returns are predictable. Quality businesses do this naturally. Weak businesses break compounding. Charlie Munger focused on protecting compounding above all. Less is more. This idea applies beyond investing. In life, focus beats distraction. Depth beats width. Patience beats activity. Charlie applied this everywhere. The courage to be selective. Choosing quality requires courage. Because you may own fewer things. You may look different. You may feel uncomfortable. But comfort does not create wealth. Conviction does. Why this principle keeps you rich. Quality over quantity. Reduces mistakes. Improves compounding. Protects against disaster. It makes wealth durable. And durability is the secret to staying rich. How crashes and volatility help. Most people fear market crashes. They panic when prices drop. They lose sleep during volatility. They think the end is near. But Charlie Munger teaches a completely different lesson. The best opportunities come when others panic. Volatility is not the enemy. It is a friend if you know how to use it. Why people fear crashes. Fear is natural. Humans are wired to survive. When prices fall, fear spikes. Anxiety rises. Impulse to sell dominates. This is survival instinct, not investment logic. Most people sell at the wrong time, the exact moment they should buy. Why volatility creates opportunities. Price volatility creates a rare advantage. You can buy high-quality businesses at a discount. A business that costs $100 today may cost $60 tomorrow. The fundamentals haven't changed. Only the emotions of the market have. Patience and discipline allow you to exploit these moments. Most investors cannot. That is why wealth is concentrated in the hands of a few. Historical examples. Think of 2008. Markets crashed. Many investors panicked and sold everything. Charlie Munger and Warren Buffett did the opposite. They invested in strong businesses at discounted prices. They waited calmly for recovery. They allowed compounding to work over the next decade. The people who panicked lost money. The disciplined few got richer. Crashes test emotional control. Volatility is a test of character. Can you stay calm when everything is falling? Can you ignore headlines, news, and social panic? Can you focus on value, not price? Most people fail this test. Charlie Munger mastered it. That's why he survived multiple crashes and market cycles. The secret: think like a business owner. When prices drop, don't think of it as loss. Think of it as a chance to buy part of a business cheaply. An owner asks, is the business still strong? Will it survive this downturn? Is this a rare opportunity to buy more? Traders panic. Owners calculate. Different mindset. Different results. Why volatility is the investor's friend. Volatility is the fuel for compounding at discounted prices. When the market shakes, great businesses go on sale. You can buy more with the same capital. Long-term growth multiplies. Charlie Munger once said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Volatility is the rain. Avoiding common mistakes during crashes. Don't panic sell. Temporary drops don't destroy fundamental value. Emotional selling cuts off compounding. Avoid chasing cheap unknown stocks. Only buy quality businesses. Cheap is only useful if the business is strong. Don't listen to the crowd. Everyone panicking is normal. Acting like them is costly. Have cash ready. Cash is optional until opportunity knocks. Being prepared lets you take advantage. The role of patience. Volatility is uncomfortable. It tests patience. Most investors can't hold for long-term recovery. Charlie Munger emphasizes, the big money is not in the buying or selling. It's in the waiting. Waiting calmly during market panic is how wealth multiplies. How crashes amplify long-term gains. A simple example. Buy a high-quality business at $100. Market crashes. Price drops to $60. Business continues earning profits. You buy more at $60. Years later, price returns to $120 plus. The gains are multiplied because you bought more during fear. Compounding grows faster. Emotional restraint created advantage. Most people miss this opportunity entirely. The psychology of volatility. Markets are driven by emotions. Fear causes selling. Greed causes buying at the top. Charlie Munger teaches, invert, always invert. Instead of asking, what will make me rich? Ask, what mistakes are others making? During crashes, the mistakes are everywhere. Disciplined investors profit silently. Volatility is a natural part of investing. It is not a sign that the market is broken. Crashes, corrections, and fluctuations are normal. They reward investors who are patient, disciplined, emotionally strong. They punish investors who are impulsive, emotional, short-term focused, turning panic into opportunity. The formula is simple. Recognize the panic is emotional. Confirm the fundamentals of businesses remain strong. Buy more quality businesses at discounted prices. Hold for long-term compounding. This is how the rich get richer while others fear. Why this principle keeps you rich forever. By embracing volatility, you avoid panic selling. You compound at discounted prices. You stay calm in crises. You turn fear into opportunity. Charlie Munger's wealth survived multiple crashes because he loved volatility instead of fearing it. Step-by-step application for everyone. Now we've covered philosophy, strategy, mindset, compounding, quality, patience, and how to use volatility. The final question is, how do you apply all of this in real life? Even if you are not a billionaire like Charlie Munger, you can follow a simple step-by-step approach to build lifelong wealth. This point is all about practical action. Step 1. Start with self-education. Before investing a single dollar, you must learn how businesses work, how markets behave, how human psychology affects decisions. Charlie Munger spent decades studying economics, accounting, psychology, history. Why? Because understanding reality prevents mistakes. Practical tip. Read financial statements. Understand business models. Learn from history, not just trends. The better your foundation, the fewer mistakes you make. Step 2. Build a cash reserve. Before buying anything, have cash ready. Cash allows you to act during volatility. Cash prevents panic selling. Cash is optional until opportunity comes. Charlie Munger always had dry powder ready. During crises, he could invest while others panicked. Practical tip. Save 6 to 12 months of living expenses. Treat this as your opportunity fund. Do not use it for emotional trades. Step 3. Identify high-quality businesses. The core of Munger's strategy is quality. Ask yourself for each business, does it have a competitive advantage? Are its profits consistent? Will customers still need it in 10 to 20 years? Can it survive recessions and crises? Avoid trendy businesses, highly leveraged companies, businesses you don't understand. Focus on few great companies rather than many average ones. Step 4. Determine fair value. Buying quality is not enough. You must buy at a reasonable price. Overpaying weakens returns. Overpaying creates stress during downturns. Munger focuses on intrinsic value. Calculate the business's long-term earning potential. Compare with market price. Buy when price is below value. Practical tip. Use simple metrics. Earnings, growth, debt. Avoid complex models. Stick to businesses you can understand. Step 5. Commit to a long-term hold. Charlie Munger says, if you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Holding is the most powerful part of the strategy. Protects compounding. Reduces emotional mistakes. Turns volatility into advantage. Practical tip. Avoid checking prices daily. Ignore short-term news. Trust the businesses you own. Step 6. Reinvest earnings. Reinvestment accelerates wealth growth. Reinvest dividends. Reinvest profits. Let compounding do the heavy lifting. The longer you reinvest, the faster your wealth grows. Practical tip. Automate reinvestment if possible. Do not withdraw unless necessary. Focus on growth, not spending. Step 7. Embrace patience and emotional control. Markets will fluctuate. Prices will drop. Headlines will scare you. Charlie Munger teaches, don't panic. Don't follow the crowd. Think like an owner, not a trader. Practical tip. Before selling, ask, is the business still strong? If yes, hold. Use drops to buy more if possible. Emotional control is a long-term competitive advantage. Step 8. Use crashes to your advantage. Market crashes are rare opportunities. Great businesses become cheaper. You can buy more with the same capital. Compounding accelerates after crisis. Practical tip. Keep cash ready. Buy high-quality businesses on sale. Don't try to time the exact bottom. Crashes reward disciplined investors, not panickers. Step 9. Avoid overtrading. Resist the urge to constantly buy and sell. Frequent trading increases mistakes. Frequent trading interrupts compounding. Frequent trading creates stress. Charlie Munger minimizes actions to reduce errors. Few decisions, high conviction. Less activity, more long-term gain. Practical tip. Focus on quality over quantity. Avoid chasing trends. Trust your research. Step 10. Continuously learn and adapt. Even after starting, the journey is not over. Markets evolve. Businesses evolve. Your understanding must evolve. Charlie Munger studies constantly, but only to avoid mistakes and improve judgment, not to chase fads. Practical tip. Read widely. Business, psychology, history. Learn from mistakes. Avoid following the crowd blindly. Continuous learning keeps you ahead over decades. Step 11. Monitor, don't micromanage. Once invested, monitor fundamentals, not prices. Is the business still strong? Are profits growing steadily? Has the competitive advantage been maintained? Avoid micromanaging daily fluctuations. Too much attention creates unnecessary stress. Step 12. Think in decades, not years. The most important mindset shift. Long-term thinking. Wealth is built over decades. Short-term market noise is irrelevant. Patience multiplies returns. Charlie Munger. The big money is not in the buying or selling. It's in the waiting. Think like this. Buy high-quality businesses. Hold for decades. Reinvest profits. Avoid emotional mistakes. Step 13. Apply to your life, not just investing. These principles are universal. Patience works in career growth. Emotional control works in relationships. Focus on quality over quantity works in life choices. Charlie Munger treats life as an investment. You should too. Step 14. Consistency is key. The secret to applying this strategy. Consistency. Apply the rules every day. Avoid shortcuts. Ignore distractions. Stick to principles. Consistency creates results over decades. No single decision matters as much as consistent disciplined action. Step 15. Trust the process. Finally, trust the strategy. Avoid obsession with short-term results. Accept that wealth grows slowly. Stay disciplined during volatility. Be patient and consistent. Charlie Munger's success is proof. Avoid stupidity. Focus on quality. Let compounding do its work. If you follow these steps, you are applying the one investment strategy that can keep you rich forever.